Nobody likes watching an investment lose value, but if it happens in a taxable brokerage account, that loss can actually work in your favor at tax time. It's called tax loss harvesting, and it's one of the most underused strategies available to everyday investors. Here's the mechanic. When you sell an investment for less than you paid for it, you realize a capital loss. That loss first offsets any capital gains you had elsewhere in the same year. So if you made $5,000 on one stock and lost $2,000 on another, you only pay tax on the net $3,000 gain. But if your losses exceed your gains, or you have no gains at all, you can use up to $3,000 of that net loss per year to offset your ordinary income, your salary, essentially reducing your taxable income directly. And if your total losses are even bigger than that $3,000 limit, the leftover carries forward to next year and the year after, indefinitely until it's fully used up. Now, the rule that trips people up, the wash sale rule. The IRS won't let you sell an investment at a loss and then immediately buy it back just to manufacture a tax deduction while keeping your position essentially unchanged. Specifically, if you sell a security at a loss and buy the same or a substantially identical security within 30 days before or 30 days after the sale, a 61-day window total, the loss is disallowed for tax purposes, and it gets added to the cost basis of the new position instead. What counts as substantially identical isn't always obvious. Selling one S&P 500 index fund and immediately buying a different S&P 500 index fund from another provider is very likely to be treated as substantially identical, since they track the same index. Selling an S&P 500 fund and buying a total market fund, which tracks a broader index, is generally considered different enough to avoid the wash sale rule. This is exactly how most people harvest losses without accidentally recreating the same position. A few more details that matter. The wash sale rule applies across all of your accounts, including your spouse's accounts and even your IRA if you buy the same security there within the window. And importantly, as of current rules, cryptocurrency is generally not subject to the wash sale rule, since the IRS classifies crypto as property rather than a security, though this is an area regulators have discussed changing, so don't assume it stays that way forever. So, how do you actually implement this? Near the end of the year, or really any time the market dips, review your taxable brokerage positions for anything sitting at an unrealized loss. If you were planning to rebalance or reduce that position anyway, sell it, realize the loss, and if you still want exposure to that asset class, buy a similar but not identical fund to stay invested while avoiding the wash sale rule. Document the sale and the offsetting purchase clearly for your tax records. Common mistakes that get people in trouble: forgetting that the wash sale window includes 30 days before the sale, not just after, forgetting to check a spouse's account or an IRA for the same holding, and swapping into a fund that's too similar to the one you sold, which risks the IRS treating it as substantially identical anyway. The bottom line, tax loss harvesting turns a bad outcome, a losing investment, into a partial win at tax time, as long as you respect the 61-day wash sale window and avoid buying back something too similar too soon. If you have a taxable brokerage account and it's ever had a position sitting at a loss, this strategy could be worth real money to you every single year. This is educational content, not tax advice. Consult a tax professional about your specific situation. Subscribe for more personal finance breakdowns every week.